and welcome to the Spark Accounting Solutions Show. I'm Jenny Q, and today I'm joined by Julie Babcock Hyde, CPA, CFM, QuickBooks Pro Advisor, Profit First Professional, and founder of Spark Accounting Solutions. Hi, Julie.
Hello.
I think this is everybody's favorite topic.
I think it's nobody's favorite topic, but it is a popular topic this time of year.
Wait. I was thinking favorite because we get to save on taxes, but you're saying no.
Well, no, like everybody does like to save on taxes.
Okay.
Everybody does like to save on taxes. But nobody likes to talk about them until about this time of year because they're like, oh, tax time's coming up.
Oh, and they want to relax and enjoy the holidays, but now they have to think about what's going to happen on April 15th.
Exactly.
Okay, fair enough. Well, you've got you've got a bonus tip today too on year-end strategies to save taxes. So let's just dive right in.
Before we dive right in, I want to say one
Perfect.
thing.
Say it.
And it's the one thing I always say. Everybody, a lot of tax planning strategies is counterintuitive to running a profitable business. The way to pay no taxes is to break even. The way to get a mortgage, the way to run a successful business, these other things is to run a profitable business. So there's a balancing act that you have to do with all of this. And so I really want people, as they're thinking about these strategies, one of the things most of my clients have heard me say at some point is don't spend $100 to save $33 in taxes. Like if you had a choice between $0 or $67, which one would you pick? Nobody's going to pick $0.
Yeah.
But they do all the time because people encourage tax strategies that take them to break even.
Okay.
And so as you're considering these, think about your goals, think about your needs, think about what's needs versus wants for your business and for yourself personally, and don't spend money on things you don't need. Don't spend $100 to save $33.
Fair enough.
Okay. So
I like that. Setting the context, setting expectations. So that's okay. So that makes sense because with many of the tips, you're saying evaluate this. You're not saying do this. Okay.
Right. So let's hop into the first one.
Let's go. Here it is.
Number one is really go through and evaluate your office and production equipment needs. So if you need a new wood chipper, if you need a new computer for the office, if you need a new drill press, if you need something for the business, either for production equipment or for office equipment, there are ways to take accelerated depreciation on that. There's options to do bonus depreciation, which means you get to expense it all in the year you bought it. There's 179 depreciation, which again allows you to depreciate it in the year you bought it, which is great. But there's one big caveat that I want everybody to know is you can't just buy it. You have to have it placed in service by December 31st. So if you go out and buy a new printer, make sure you get it set up and print at least one business document on it. If you go buy a new lawnmower for your business, make sure that you get it out and test it out, make sure that it's working. If you get a new snowplow, again, get it out, make sure it's working. Don't just get it and let it sit there. It has to be placed in service. And this is anything from computers, machinery, equipment. We're going to talk a little bit more about vehicles in a minute because there's a bunch of special rules for vehicles. But think about these things. Don't spend money on things you don't need, though. If you need one piece of new equipment, don't buy two. Don't buy two just to save 33% on taxes. It doesn't make sense. So that's the thing I always stress with this is like really evaluate your needs. What are you going to need in the next year? Is it something you need in the next year? Is it something you need You really don't need next year. You're just buying it because you don't want to pay taxes. Well, it doesn't make sense. So,
Yeah. Okay.
choose wisely. And if you're not sure if it's something that's going to qualify for depreciation, check with your tax preparer and say, hey, I'm thinking about buying this. Is this going to qualify for some kind of accelerated depreciation in 2021 for my taxes? And make sure you get the thumbs up. There's nothing you would hate worse than, spending $10,000, $50,000, $100,000 and then finding out that you're not going to get the tax impact
Oh God.
that you thought you were going to get from it.
Right.
Especially if it's something you didn't need anyway.
Exactly.
So
right.
be careful. Loop your tax preparer in as you're thinking about any of these strategies.
Okay. Perfect. Okay. Now, number 2 is interesting. I can't wait to hear this one. Evaluate your retirement savings options.
So people that have heard me talk before, well, especially business owners, hear me talk a lot about money being in their right pocket or their left pocket, which is like their business account or their personal account. When I start talking about retirement, I usually start talking about your back pocket because that's money that you're going to put away for later. With retirement, this is one of the few places where you can actually keep money for yourself and get a tax deduction for it. And so, like most of these other things that we talked about, like if you're buying equipment or something, somebody else, you're giving the money to somebody else and you're getting something else. This is one where you're actually putting money away for retirement. And there's a lot of deductible ways that will save you taxes now to save for your retirement, but you have to make sure you pick the right one. So there are traditional IRAs. There are simple IRAs. There are SEP IRAs. There are 401ks. There's all kinds of options out there, and those are just a few. And picking the right one for your business and the one that you can actually still implement for 2021. Some of the deadlines have come and gone. Some of them are still available. So understanding your goals, understanding your income, understanding your full tax picture is going to be important because depending on, for a traditional IRA, depending on whether you're married and how much money you make, and if your spouse participates in a retirement plan, that may affect the amount of deductible traditional IRA contribution you can do. Simple IRA is probably too late to implement for this year, but you might be able to do it for next year. If you already have one set up for this year, that's cool. You can look at maxing that out. A SEP IRA is something you don't have to implement right away, but you're going to have to contribute the same percentage for yourself as you do for your team members. So choose wisely. 401k, again, a lot of times you can still get those set up through the end of the year. You've got to find somebody that can do it for you, though, and you can defer and you can do employer match on that potentially as well. So it's really important to understand what your goals are, how much you want to do, and how much you have to contribute for yourself and for your employees based on what you select.
And so if somebody's listening to this and they're like, oh, I want to check into that, who's the first person they contact?
They should definitely reach out to their tax preparer. And if you don't have a tax preparer, feel free to reach out to me. And we can either help or refer you. But you also probably want to talk to your financial advisor as well to find out, hey, can we even get this implemented for this year? Between your tax preparer and your financial advisor, they should be able to get you on the right track for what your options are.
Okay. All right. There you go.
Yeah. And again, I love this because this is one of the few tax deductions where you actually still get to keep the money.
Yeah. You're not buying something that you may or may not need.
Yeah. It's something you are going to need retirement funds later in life, most likely.
Right.
So,
right.
So this is a great way to keep your money, but still get a tax deduction.
Okay, perfect. All right, let's hop on to number 3, managing timing of expense and income recognition for cash. Easy for me to say, cash basis taxpayers.
This is kind of just kicking the can down the road, basically. There are ways to accelerate paying expenses and hold off collecting revenue. If you're a cash basis taxpayer, most small businesses are cash basis taxpayers. But it enables you to prepay some expenses this year. Now you can't prepay for more than 12 months. There's some rules around that again. So you really want to probably strategize with your tax preparer about this. The other thing to think about as you're doing this, like let's say you want to prepay rent, and let's say you want to prepay like 6 months of rent. Well, your landlord might be mad at you for their own tax planning if you do it in a way that they're going to have to claim that income this year as well. And so the fun thing about cash basis taxpayers is, again, if you have the check written by 12/31 and have it postmarked by 12/31, it's not going to get to your landlord's hands until January of 22, right? And so you take the deduction in 21 and your landlord is still going to be able to claim that revenue in 2022 because they didn't have the payment in hand. So think through these things. Be careful that you don't make any of your vendors mad by messing up their tax planning and prepaying for things. So think through this. So that's with expenses. You can like prepay some things. With your customers, a lot of people will just like hold off invoicing until January. If they're like, oh, I have too much money already this year, I'll bill you in a couple days. And so that they collect those funds in 2022 instead of 2021.
Interesting.
All it's doing, if we take more deductions this year, we're going to have less deductions next year unless we keep the cycle going.
Right.
So it's not like that. It's not like this is necessarily a permanent strategy. It's not going to permanently reduce your taxes. It's just moving that deduction into this year or moving that revenue into next year, kicking the can down the road. If you know that your income next year is going to be lower than this year, you may want to do that so that you can, lower your income this year and you already know you're going to have a lower income next year.
Right.
There's reasons to do this. There's reasons not to do this. And the one thing I always like to have people think about when they're kind of doing this shuffling between years is, what do you think is going to happen to income tax rates right now? I think most of us, if we use little thinkers right now, most of us are expecting income tax rates to go up. And so maybe it's not a great idea to push stuff so that we've got, lower income this year and higher income next year, because we may end up paying a higher income tax rate. So choose this strategy wisely. Again, talk with your tax advisor to think through this and think through how you do this and how you implement this so that you don't end up, doing a great thing for yourself this year and doing a horrible thing for yourself next year.
Just listening to you talk about all this strategy, I'm picturing this huge like game of life combined with risk and maybe a little Monopoly. It's like this just big.
It is. It is. The only thing you forgot is the magic 8-ball.
Right.
The only thing you forgot to help us kind of predict what's going to happen.
So someone please invent that game for accounting. That'd be awesome.
We need it. it.
Okay, perfect. All right. Number 4 is evaluate your vehicle needs. So this I think is more common. Like people are like, oh, I should just buy a new truck or whatever, right?
Yeah. So I want to talk through this because there are special rules for all different kinds of vehicles. Some vehicles have limited depreciation, other ones do not. And so a lot of people know that like there's special rules for SUVs. Well, not all SUVs. They have to weigh more than 6,000 pounds. And with those SUVs, you can actually either elect bonus depreciation and expense 100% of the business portion of the vehicle this year, or you can do some Section 179. But it has to be a qualifying vehicle. And so you really, again, plan through this. So that's an SUV. We've got qualifying pickup trucks. And again, there's certain criteria that have to be met. The bed length has to be so long. The weight has to be so much. We've got qualifying cargo and passenger vans. Again, this is not the minivan. This is not a minivan. This is a qualifying cargo or passenger van where we've got more seating or more storage in it. Again, we've got options for full depreciation for these things. So we can fully expense them. Even if you finance it with an auto loan, you could take the entire deduction this year. Now, let's talk about that, because what's good, what's bad. If we take all the deduction this year, we get the tax savings this year, but we're still making payments on it for the next 5 years. So we get tax savings this year, but payments in the future. So you got to think through, is this really the best decision to, depreciate all of this year? Should we split it out? Vehicles are funny because there's luxury auto rules. And if you go above a certain value, you have to spread out that depreciation unless they meet some of these qualifying rules. So the last type of vehicle is vehicles with limited depreciation. And so if you just go buy a normal car, you can take some bonus depreciation, but you can't take as much, and you certainly can't take 100% like you can for the SUV, the qualifying pickup, and the qualifying van. So choose wisely. These things are expensive, though. These new trucks, $100,000. Cargo vans, trucks $60,000. Cargo vans, $100,000. These things are expensive.
So what about the year? Does that have to be brand new?
Some of these have to be brand new. Some of them can be used.
Okay.
So again, strategize with your tax professional to say, this is what I'm thinking of buying. They're going to be able to be like, based on that gross vehicle weight and based on the newer used, these are the tax benefits that you could get from it this year. So it's always good to have an idea of what you want and run it past your tax professional to make sure that you are meeting what you want to do. And and really know that, there are some vehicles with limited depreciation. There are some that you don't have to worry about it. And so picking what you want, but I see people that buy too much vehicle simply because they want the deduction. Spending $100 to save $33 doesn't make sense. If you have to finance this vehicle and you have to pay payments for the next 5 years, make sure you really need it, because that's a 5-year commitment to get this deduction.
Right, with probably interest.
Exactly. So choose wisely, run it past your tax preparer to make sure you're going to get the outcome that you're looking for.
All right, perfect. All right. We're going to go on to number 5. And this one is interesting. I can't wait to hear. This one kind of surprised me. I'm not going to lie.
Yeah. So through, I think it was through September 30th of this year. This was introduced last year in the Families First Coronavirus Response Act. There were wages available, government money to help people pay for when people were out sick for COVID. They expanded it to include people taking time off because they had to go get the vaccine, or because they weren't feeling well after the vaccine, because they had to take care of family members with COVID, because they were quarantined because of COVID. And this doesn't just apply to your employees. It can apply to you, the business owner, as well. And even if you are a Schedule C self-employed person, you can take advantage of this and take this credit on your tax return. And so it's really important to know, if you're on payroll or your employees are on payroll, this is something that you may be able to go back and amend your payroll tax returns to claim some of this sick time if you've had people out with documented COVID, taking care of people with COVID, vaccinated. There's several reasons that these credits are available. And I think a lot of people either their payroll system wasn't really well set up to track it, or they just really didn't know about it or didn't pay attention to it, that might have some opportunities here, especially with, we've got in Idaho, we've got about 50% of the people. So, chances are that half of your team probably has been vaccinated and may have missed a day. And so you start looking at the value of those credits and helping out with wages for that missed time. This can add up. So don't take a minute to stop and think about if you might qualify for this.
Okay. All right. Now's the time to do it.
Yeah, exactly. If the period where you can claim these wages ended September 30th.
Yeah.
But it doesn't mean that you can't go back and look at your payroll for that time frame and possibly amend your payroll tax filings to get these credits.
Awesome. Okay. And you have a bonus for us.
I have a bonus tip because this is the time of year that, again, we're trying to get creative. We're trying to find ways to save money. And a lot of small business owners have kiddos. And a lot of times those kiddos do stuff to help out with the business, whether that's hanging flyers on doors, whether that's filing, whether that's cleaning the shop. There's a lot of things that kiddos can do to help with the business. And if you're not paying your kids, you maybe should think about it.
Mm-hmm.
Um,
Mm-hmm.
and so with kids, if you are a sole proprietor, you can hire your kids, put them on payroll, give them a W-2, and neither the kiddo or the parents, the owners, have to pay the employment taxes on that. So Social Security and Medicare doesn't apply. There's special things you
Interesting.
have to do to evaluate that. That's for sole proprietors. If you're taxed as an S corporation or a C corporation and you're employing your kids, you will have to pay those taxes. But remember that kids basically can make up to 12.5 without paying taxes on that. And let's go back to our retirement idea. They can take that money and they could put it in a traditional IRA because it's earned income. They could put it into a Roth IRA. If they only made 12,000, they don't need a deduction anyway. They can put it in the Roth IRA, no deduction now. It's going to grow tax free and it's going to be there available for them when they retire, maybe to help with school, all the things that you can do potentially with your IRA.
Right.
And that enables you to move money from your effective tax rate legally because your kiddo is actually doing work for you. Now, you can't pay somebody $12,000 because they took out the garbage once. Okay. They think that's what it's worth. I know
Yeah.
that. That's what they
Yeah,
think
they
it's
do.
worth.
They definitely do. Yeah.
But the IRS is not going to agree with you, or the Department of Labor is not going to agree with you that
Right.
one trip to the garbage can
Right.
is worth $12,000. You can have your kid try to argue for you because they think it was. But you have to pay them reasonable compensation for the work that they did. But this is a way again to shift from your marginal tax rate money down to a 0% marginal tax rate if they're under the 12,000 because they can take the standard deduction
Brilliant. Yep.
up to their earned income amount.
Awesome. Perfect. Love it. So good. And you also are offering, and it's down here at the bottom of the screen, you're offering the 5 core chapters of Profit First free. Just download it, print it. It's yours. What can people expect to learn from that?
So I think the two biggest things, especially in this topic of tax planning,
Yeah.
one of the things that we love about Profit First is the cash management system. And one of the things it teaches you to do is save for taxes. There are so many small business owners that get to April 15th and get their tax bill and they want to cry.
Oh, no.
If your business, when you get your taxes done, your tax preparer is going to give you estimated taxes to pay for the next year. And that's based on your last year's income.
Mm-hmm.
So if your business doubles this year, your taxes are probably also going to go up. But if you only pay in your estimates, that's probably all you've saved. And so this sets up a system where you're consistently saving for taxes. You're ready to pay that tax bill, and you're not making a desperate decision, spending $100, financing $100 to save $33 because you don't have it. And so it really gives you the freedom and the power to stop when it comes to for tax planning time to really think through, do I need this? Do I want this? Is this really beneficial to the business? Because I have the money I need to pay the taxes, but would this piece of equipment help my business run better? Would it help us be more profitable? And you stay focused on profitability rather than, holy crap, where am I going to get the money to pay my tax bill this year?
Yeah. Yeah. Awesome. Perfect. That's an easy download. bit.ly/spark PF book. So we'll also put that in the description. And it's just an easy link.
Awesome.
Okay.
Awesome.
All right, Julie, as always, thank you for all of the amazing information. And if somebody has any questions like that's specific to their situation, what's the best way to contact you?
If you want to hit the contact us button on our Facebook page, that is an easy way to get a hold of us. And we will get back with you and hopefully help you out or point you in the right direction.
Perfect. Awesome. Thank you so much. All right, everybody have a great day.